Thanks for tuning in to this broadcast of The Resilient Advisor. My name is Jay Coulter. Regular listeners and viewers know that I've been on a personal quest for a deeper understanding of quantitative analysis and portfolio construction. And like most professionals my age and older, our careers were built on fundamental analysis. It's all we were taught. It's how we built portfolios. And I've really enjoyed this journey. When I first started, I asked my good friend Clinton Sorensen of Wealth Shield who I needed to follow on Twitter to start my research process, and the first name he sent me was Corey Hoffstein, my guest here today. Corey is the Chief Investment Officer of Newfound Research and host of the popular podcast Flirting with Models. If you are on Twitter, he is a must follow if you're in our industry, if you're interested in deep, data-rich content on quantitative analysis and risk management. Corey, thanks so much for coming on the podcast.
Jay, pleasure to be here. Thank you for that very warm intro as well. I always get concerned when people find me on Twitter. I got to be a little bit more careful what I'm putting out there.
Oh, man, the content you produce is fantastic. And for listeners and viewers, I told Corey beforehand, this podcast took a different construct for me because I've become a bit of a fan of Corey's because his research has really led me down multiple paths as I'm trying to increase my understanding of quantitative portfolio construction. So, Corey, this is a real treat for having us on. It's a real treat having you on. I really do appreciate it. Could we start by talking about some of the work you've done? Because I think our viewers, who are mostly financial advisors, if they want to start down that path, you have some great papers out there.
I would love to. That's a great place.
So the first paper that I found myself reading was called 2 Centuries of Momentum. And the paper starts off with, and I'm going to read this quote, "A momentum-based investing approach can be confusing to investors who are often told that chasing performance is a massive mistake and timing the market is impossible." What a great way to start a paper. Corey, at a high level, for advisors that have not considered momentum in their portfolio construction from the historical lens, why do they need to do that?
Well, I think almost all of us investors, almost everyone I talk to starts with the same journey, which is you start as a value investor. You imagine yourself as that future Warren Buffett evaluating individual securities. And there's nothing wrong with that. You read the Ben Graham books and you learn about individual security selection, and all of them talk about trying to identify the value of a company, the security versus the intrinsic value, and trying to find the gap so that you can invest with that margin of safety. Momentum investing and trend following, which is a close cousin of momentum investing, really just seems very foreign to that style, where it's effectively saying we're not going to care at all about what the fundamental business is. We're not going to look into the balance sheet. We're not going to look into the income statements. We are simply going to look at the price of the security. And if the price is outperforming its peers, then we want to invest. And if it's underperforming, well, then we want to avoid it. And it seems very naive at first, right? How can such a simplistic strategy work? Anyone with kids, they could probably teach their 5-year-old how to run that strategy. Go look in the newspaper and go sort these stocks and tell me which ones are winning, and those are the ones I can buy. The reality is, though, when you start to dig into the literature, there's all sorts of technical connections as well as behavioral connections that momentum is tied to. And I think those are really important to understand where this sort of phenomenon can come from. So it's been well documented in individual securities, across country indices, commodities, currencies, fixed income space. So there's a lot of empirical evidence supporting it going back a really long time. And then when you tie that to all the sort of behavioral anomalies that we tend to exhibit that can give rise to the momentum effect, all of a sudden it becomes, well, maybe this isn't so curious after all. It's just a different way of trying to measure how information flows into the market and how we can take advantage of the behavior of other investors, or better put, the misbehavior of other investors.
What I took away from that article that really hit home with me is talking about the rise of the fundamentalist investor, which is really falls into my investing lens historically, and then some of the characters throughout history that have done well with momentum investing. What would you say is the best example of a character from history who's done well with momentum investing, and then why that fundamentalist period came about?
Well, there have been a number of investors who have done well with momentum. I think some of the ones of the modern era that maybe people don't have a name for, but this whole category of investors of managed futures, commodity trend advisors, when you look at the performance of funds like Winton and their peers, they have some of the best track records going back 40, 50 years of applying trend following techniques in the future space. Again, trend following and momentum being very close cousins. So what you find is that even though these aren't necessarily individual names that we know of, a lot of these big hedge funds that have been so successful for 30, 40, 50 years have adopted this approach. I think it ties in very closely to the idea that they're just systematically cutting their losers and letting their winners run. And that sort of pattern of just being completely cold about and systematic about when you're going to get rid of things that are going against you and how you're going to sell things eventually when you take your profit, that approach can be instrumental in ensuring you achieve that long run performance. Now, your second question, which I'm currently blanking on, what was it?
So it was about, and I was trying to set you up for a follow-up question. So it was about the rise of the fundamentalist investor,
Yes.
who construct portfolios through that lens, like myself historically.
Yeah, so what's really interesting to me is we went through this period as an industry, modern portfolio theory, when we saw that in the 1950s, 1960s, where there was this approach of tying mathematics to markets. And you would think that that would have been pushing more towards things like momentum that you could measure quantitatively. Interestingly enough, it seemed to get rid of things like momentum that were sort of eschewed as just being technical analysis. You had this sort of academic approach to, we need these foundational theories for how the market works. And then the sort of Warren Buffett success over time said, okay, this is the way you need to view securities. This is the intelligent investor approach. And anything other than looking at this as an individual security and the balance sheet and all that sort of stuff is just not intelligent, quote unquote. And so you saw this sort of stuff that got lumped as technical analysis, really thrown away. And so I think there are, again, some really useful quantitative techniques like momentum that aren't necessarily technical analysis. They have some cousins in the space of technical analysis that got underappreciated for a long time, despite their empirical success.
And then bringing this to my generation, Generation X, and the baby boomer advisors who are still around, our first exposure to this type of investing process, most of us were inside of a broker dealer. It generally came in the form of a managed futures fund that was typically sold for an 8 to 12% commission, which is amazing. That didn't work until it worked. And when it worked, it was fantastic. Saw a ton of inflows, and then, of course, did not work after the fact, which I think is why, personally, I've anchored some of my historical thoughts about the process to a product instead of a strategy, and why you see these newer generation, in my opinion, of advisors and folks like yourself who are taking this quantitative approach to building portfolios and leveraging it into, and we'll get into the indexes that you construct later, and being able to deliver results. Is that a fair assessment?
I think it's very fair, and I think it's an important part of the reality of the world we live in, which is when we are delivering these products and services to an end client, they have to be able to stick with it. And so even if you think managed futures can work over the long run, if you go through a 4 or 5 year period where you've paid a lot for a product and continue to pay a lot, and the product doesn't seem to be performing versus the benchmark that individuals tend to look at, which is just the S&P 500 or the Dow Jones or whatever their sort of personal benchmark is, whether that's appropriate or not is a totally different discussion, right? But they tend to look at what the market's doing. And then they go, I don't understand this. It's expensive and it doesn't seem to work as well as something I do understand. So why am I holding it? And I think it's really hard as an advisor to push back on that for 5, 6, 7 years for that 1 year where it really does seem to work. And so I think it's not surprising when we see asset flows come in and come out to these style of products for exactly that reason. I just think they're hard. They can be very hard to hold for a long time unless there's a deep understanding of how they work.
Yeah. All right. So before we move on to the next research paper that you put out, I listened to the podcast interview you did with Michael Batnick, the Animal Spirits podcast, and it was a fantastic interview. He does a really good job of pulling out great technical questions. And I encourage listeners, if you're not subscribed to that podcast, go subscribe and listen to that particular interview. In there, you did a great job of articulating the difference between trend following and momentum, which can be hard for novices to the space. Would you mind walking listeners through that difference?
Absolutely. And I think this is so confusing to novices to the space because they're almost always measured the exact same way when you go to actually try to measure what is momentum and what is trend. What momentum really says, the way we think about momentum, is that we're trying to compare two different things to each other. So we are going to look at the prior return, say, of two stocks, and we're going to say which one is performing better, which one is performing worse. And what we want to do is then buy the one that's performing better and avoid the one that's performing worse, or potentially, if you can short the one that's performing worse. The expectation is if you've been outperforming your peers, you will continue to outperform. If you're underperforming, you'll continue to underperform. What's really important about this is there's no question as to whether that return is positive or negative. So if the whole market is going down, what you're effectively doing is rotating into those stocks that are perhaps going down less, avoiding those stocks that have gone down more, with the idea that going forward, those stocks that have gone down less will continue to potentially go down less. That's the idea of momentum. Trend, on the other hand, is more of an absolute measurement, which is looking at a security in isolation and simply saying, is the return positive or negative? If the return is positive, then we think that going forward, the return will continue to be positive. If it's negative, it'll potentially continue to be negative. And so when we think of momentum, it's really about relative performance and how do we create alpha and excess return when we're investing within a universe, whereas trend following is really more about how do we avoid losses? How do we try to only invest in things that are exhibiting a higher probability of increasing in value rather than decreasing in value?
Once again, such an articulate way to describe a concept that's really hard for people new to quant to think through, especially if they're building portfolios. All right. So as the crisis was unfolding, you put out a paper on what you were calling, where you were analyzing different recovery scenarios. You called it the LUW or LUVWY recovery, and it is so data rich and provides such great context for all the different outcomes. In conclusion, you had decided that an L-shaped recovery was going to be bad for everybody, but a U and a W and a Y, there were high levels, some things to consider. And to be fair, in the paper, I'll have links in the show notes. You go and you model out the outcomes from drawdowns ranging from 30 to 60%, and you were very methodical and thoughtful about the time periods for the lookbacks. Could we walk through each of the potential recoveries and what you see today here towards the end of April as things advisors should consider, not forecasting, but just the math behind it?
Absolutely. Absolutely.
So, which one would you like to start with?
Well, why don't we start with the V? Because I think that's maybe the one we're all hoping for, right? Regardless of how you're invested, I think we all want to get the economy back on track. So the idea of the V-shaped recovery, and the whole idea of this paper was, there's a lot of people speculating as to what type of market recovery are we going to see. A V being we sold off fast and we're going to recover just as fast. And so these letters are trying to draw out the shape of the market recovery. But what it doesn't necessarily capture, and what I was trying to work on in this paper was, well, how deep is that V? How long does it take to hit the bottom? How long does it take to get back up to the top? And by the way, just because it goes from here to here, back up to here, there's a lot of squiggles and paths it can take along the way. And so what's interesting about trend following as compared to a lot of other different types of investing is trend following is very mechanical. If you give me the price path, I can then run a trend following strategy on it, even if it's completely a hypothetical price path. But what I don't have to do is I don't have to come up with what are company fundamentals and all that sort of stuff. So I can kind of, given what these different scenarios the market can take, I can try to simulate out how different trend following models might do. And so that's ultimately what we were trying to attack in the paper. So if you want to, do you want to show the graphs that are related to these, or do you want to just sort of talk through them?
No, I'll put up the graphs right here.
Yeah, so I think so here what I'm showing in this quick graph is just what these sample paths might look like. So as I said, what I'm effectively trying to do is for a given drawdown level, for a given time horizon, how long does it take to get to that drawdown? I then simulate out a market path. So in orange there, it's somewhat of a V. It hits the bottom and then bounces back all the way up to recovery. In the gray, you have more of a U. So even though there was some initial early recovery there, which is just pure random noise based on the sort of simulation techniques, it does eventually go to the U bottom, and then it U's all the way back up. In yellow, you can see more of a W pattern. Again, not a perfect W. There's all some noise here, but it makes that recovery and then touches the bottom again, goes back up. And then in blue, a much more sort of sad shape, which is we just sort of hit the bottom and then fizzle out and never make a recovery. And so this just sort of, again, one sample path we're looking at. In this study, simulate, I think it was over 20,000 sample paths for each of these. But then what I'm going to do is look at each of those recovery types. So that, as you mentioned, it is data rich and it's a bit of a data dump. So I would definitely encourage people, if you're going to look at this, let your eyes gloss over and just look at more of the colors rather than the individual numbers. I think that's more important. And the general takeaway from this graph is orange means worse, blue means better, white means somewhere in the middle. And what we see, and the pattern we're going to see, is that the important takeaway here is that the type of trend following strategy you want to use that's going to be successful is going to be highly dependent on how deep of a drawdown do we have, how fast does that drawdown happen, and what style recovery do we see. And so for something like a 30% drawdown, which was not very far away from at the point I did this study, what you can see here is on the sort of the y-axis of the tables, where you see like it says 7, 21, 63. That's how many days it would take to get that drawdown. For very fast drawdowns, a 7-day drawdown to get to a 7 days to get to a 30% drawdown. Well, you need to use a really, really fast trend model. You can't have something that's slow, that's going to contemplate, that's going to take some time to digest. Now it's got to make a quick decision to get you out. And similarly, for that recovery from the bottom, which is only going to take 7 days to get back for a really quick one, you need a really fast trend model to get back in. What's really interesting is you might see on that very top table, all the way to the right, it looks like you see a big blue splotch there. Like it did really well. Mm-hmm. And so that what we have on the top is just basically different trend model speeds. Far left is really fast. Far right is super, super, super slow. Slow as molasses. And the reason that one does really well is because it just never got out. So it never got out, never had to get back in, just sort of broke even on the whole trade. Now you felt the experience of the entire drawdown and all the way back up, but you never got whipsawed. And so what we're looking at here ultimately is if you have certain beliefs around how far the market's going to draw down, if you have certain beliefs around how the recovery is going to look and how long it's going to take, you can sort of come to this graph and say, okay, given these beliefs, let me find the type of trend models that might do better than others.
Well, that's a great segue into the next paper that I'd like to talk about, and specifically specification risk. So last week I had Gary Antonisi on, and he walked us through his dual momentum investing strategy and specifically the GEM. And I found that fascinating as a tool to learn the constructs of building models using quantitative analysis and a simple guide for the absolute and relative momentum. In your paper on it was called a fragility case study, dual momentum GEM, you walk through some of the challenges with using a model like that because of specification risk. Would you please walk listeners through it like they're novices like I am to this side of the business?
Sure. And I want to start by saying I have a lot of respect for Gary. I think Gary has done a tremendous amount to promote a style of investing that I believe in. Gary and I probably agree on 99.9% of things. It's just maybe a 0.1% of the details, but I think those details are really important. So what is this paper about? Well, ultimately what this paper is about is that there's a whole lot of different ways in which you can try to measure what is a trend, right? We're talking about saying, well, you want to invest when there's positive trends because you think things will keep going up, and you want to avoid investing when there's negative trends. The big question becomes, well, how do I actually measure what a trend is? So we just saw in that last paper that depending on the type of recovery that you think there might be, you might want a fast trend model, you might want a slow trend model. In Gary's initial GEM strategy that he proposed, he used what was, I believe, a very simple end of month rebalance schedule where he looks at 12-month prior returns. And so what we could do is go back to the tables that I put together and find sort of equivalent speed of a 12-month prior return and say, oh, look, here's all the sort of recovery styles in which this model will work really well, but I bet I can find a bunch where it really doesn't work well. And so what the fragility case study is really all about is saying, well, that's just one specification of a trend model. There's all these other ways. If you believe a 12-month return works, is there any reason to believe an 11-month return doesn't work, or a 13-month, or even a 6-month? And if all the empirical evidence suggests that all of those different trend models actually do work over the long run, why are we picking just one of them? Why wouldn't we want to diversify the same way we diversify across stocks, right? We don't just pick one stock, we diversify our choices. Well, my view is we shouldn't just pick one trend model, we should diversify across trend models. And so what I was trying to point out in this study was not meant to be an attack on Gary's overall philosophy. It was really just meant to point out, hey, if we think dual momentum gem with 12-month is great, I think it can be improved if we do it with 11 and 10 and 9 and combine them all together so that we get more of a dimmer switch effect, not this all-in, all-out effect of just having one signal that tells us when to be in or out of the market.
Yeah, I can tell you, listeners, if you are looking at exploring the research behind quantitative investing and model construction using these constructs, I recommend reading Gary's book, Dual Momentum Investing, first, and then visiting this research here by Corey, and it'll help expand your thinking. Gary's book provides a great base, and this provides a different lens. And this lens is actually something that led to the reason we originally connected. And this is a construct of a different way to look at risk. And the way that you are proposing to look at risk is through not just a what do you invest in, but a what, when, and how. And I'm going to throw a couple of slides up here, but would you like to just walk us through what you're proposing in this model?
Yeah, absolutely. And I want to touch on something you just said. I should state that I actually recommended to someone this morning who asked me about researching this style of investing, what they should read. And I said, you should go read Gary's book. He said, I don't agree with everything in it, but I think it's a great foundational starting point. I think he's done a tremendous amount of research. And then from there, we can have a conversation. But I think it's really, just because I disagree with some of the details doesn't mean I don't think it is a terrific resource for anyone who's interested in getting started in this style of investing or learning more. So to your question, this framework of what is diversification? So investors typically, when they think of diversification, think of what are they investing in, right? So I'm going to diversify my exposure to stocks by buying some bonds. I might buy some US equities. I might buy some international equities. And that is traditional sort of correlation-based diversification. And what we find time and time again is that in a crisis, we see those correlations tend to spike to 1. That diversification tends to fall apart when we need it most. So we get all this ample diversification when markets are rallying, which really isn't what we want, because as markets go up, it means we're paying a cost of not being in the best market. We're paying, if equities are rallying for a decade and we hold a big chunk of fixed income, well, then unfortunately, we're paying that spread of not being invested in equities. And then on the other hand, as we saw in municipal bonds and investment grade corporates in March, great, you diversified into fixed income and they sold off just as hard as equities. So what you invest in is just one way of thinking about diversifying. The way we've chosen to expand it at Newfound is to think about also how you're making those investment decisions and even when you're making those investment decisions. So how I think for most people is, when you think about your traditional asset allocation is just very basic buy and hold strategic rebalance. But that's certainly not the only means by which you could make decisions of what to invest in. You could use things like trend following. You could use things like momentum. And the idea there is that if diversification and rebalancing, which is, let's say your average investor holds a 60-40 that they rebalance every once in a while, well, that's intrinsically introducing a mean reversion strategy into your portfolio. When the market sells off, you end up selling bonds and buying stocks. When the market rallies, you sell stocks to buy bonds. So you've got mean reversion that strategy is introducing to what you do, whether you realize it or not. If you don't necessarily want to only rely on that approach to how you're making your investment decisions, well, you might introduce something complementary like momentum, which is going to say when stocks are going up, keep investing in stocks. When stocks are going down, sell more stocks. And so then we get some how diversification. When I think is totally overlooked and is a complete obsession of mine. I'm known as the rebalance timing luck guy. I've written papers on this. I've got one that I just submitted to another journal with my team. And this is all about the idea that when you make an investment decision can have a hugely profound impact on the returns you ultimately achieve. And I think the very easy way to think about this is I'll use an example, which is, let's say we were doing trend following and we were looking at the end of the month at 12-month returns. So we're using a Gary style strategy. At the end of February this year, you would have stayed 100% invested because 12-month returns were still positive. At the end of March, because 12-month returns were now negative, you would have completely exited your position and you wouldn't have gotten any protection necessarily on the way down. Had the market unfolded just a little bit differently, let's say the sell-off started 5 days earlier than it did, what would have happened is 12-month returns would have actually been negative at the end of February, and you would have missed most of the sell-off. So that choice of when to rebalance by looking just at the end of month makes you very sensitive to how market events unfold. And so that's just one example in the world of trend following, but it actually has a big impact even for something as simple as rebalancing. If you rebalance once a year, your 60-40 portfolio, the choice to do it every August versus every December versus every March can actually have a huge impact on the results you realize over time to the tune of hundreds of basis points a year.
Yeah, I'm not going to lie, Corey. I thought about sneaking in a discussion on rebalancing because I really enjoyed your work. Maybe we could do another podcast down the road
Absolutely.
when your paper comes out specifically on rebalancing. There's another slide in the deck that you put out that I think really makes a lot of sense for an advisor to contemplate when making allocation decisions through your framework, and will be a great dovetail into the work you're doing at Newfound research. Would you please walk us through this?
Yeah, so I should state that I absolutely stole this slide from PIMCO. hence the little source PIMCO there. Every time the slide is shown, I reduce the font a little bit, and eventually I'll just outright steal it from them. But I just thought this was such a great way to communicate this idea of risk management. So one of the phrases that we use a lot at Newfound is this phrase, risk cannot be destroyed, it's only transformed. I think there's this big expectation typically that when you're investing, you can try to do things to avoid risk and outright eliminate losses. And I think a much safer way of thinking about portfolios is it's always a trade-off. So there's all these sort of like common ways in which people try to manage risk that are listed here. So being long US Treasuries, well, you typically see that there's a flight to safety benefit. And so this is the typical way people might think about managing risk in their portfolio. They buy some stocks, they buy some US Treasuries in whatever proportion they feel comfortable with. When stocks sell off, you typically see treasuries pop pretty well. The risk, of course, there is it's not going to be all that effective if you hit a prolonged rising rate environment. That's going to be a drag on the return that you see in your treasuries over part of that period. But that's not the only way you can manage risk. Trend following is another great way, in my opinion, to manage risk. It's going to work really well when markets are clearly trending. When you hit a market like 2013, 2017, and the market goes straight up, that's an easy trending market to just say, be 100% equities. On the other hand, you get a market like 2008 where you start to see things sell off and then accelerate over an 18-month period. Clear negative trends, get out of the way, avoid a lot of losses. When is it not going to work though? Well, if you got sort of a slower moving trend system and the markets hit all-time highs in February and then reverse in the fastest sell-off we've ever seen in U.S. recorded history, might not get you out of the way as fast as you want, right?
Right.
So we've got other things too, like alternatives. I mean, this is your alternative risk premia that got really popular over the last couple of years. They can do well because they're uncorrelated to market beta. They don't necessarily zig when other things zag, totally independent, introducing some really interesting diversification. but they're not riskless themselves. We saw this in 2018. Almost all the risk premia sold off at the same time. It was just a bad year for every asset, every style, every strategy. And then there's explicit tail risk hedging. People can buy puts or put spreads to try to protect against sudden drawdowns. But what you find is it can be really expensive over time. It's not going to work very well for you when the market's going up. And if you hit too shallow a decline, you keep buying protection that never gets hit. And that insurance cost can be really expensive. So the idea here is that there's no silver bullet, that when we think about building a comprehensive portfolio, what we want to think about is combining different risk management techniques, diversifying the way in which we diversify, so that we are not necessarily left naked to the risks of one particular market environment where our risk management technique might not be that effective.
Well, I love this slide, and I missed that you had sourced it to PIMCO at the bottom.
That's because it keeps getting smaller.
So now I can steal it, and I won't feel bad for taking content from a guest for my desk.
That's right.
Well, so that's a great segue into indexes that you guys construct at Newfound Research. First, could you tell listeners, besides producing prolific amounts of material, what do you do at Newfound Research?
Yeah, so Newfound Research, we are actually, despite being probably most well known for the research that we publish, which you can find on our blog and we publish weekly, we are a quantitative asset management firm. We really specialize and try to focus on this idea of helping investors navigate the risks that they're going to face throughout their lifetime. We very much believe on a risk-first style of investing. Let the returns take care of themselves by giving you access to markets, but really try to tactically and systematically implement methodologies that can help you avoid those ugly left tails and big market sell-offs that can be so detrimental to investor experience. And so that's really what we focus on as a quantitative firm, these sort of tactically risk-managed investment strategies. They're available as separately managed accounts, mutual funds, and we launched an index last year that's now tracked by an ETF that's available in the market.
And I'd love to dig into that index and how you guys construct it from a high level. How could listeners find out more information about the work you do?
Absolutely. So if they just go to our website, thinknewfound.com, there is a labyrinth of links that I'm sure they can follow. But at high level, they'll see very clearly our investment strategies, different styles of investment strategies, depending on what they're looking for, whether they're an individual investor, institution, or advisor. It sort of helps navigate them to more information on this sort of style of investing.
Yeah, I've spent a lot of time on that site, Corey, and learned a lot. It's a great resource. Let's dig into this index that you guys created. So specifically, this is the Newfound Resolve Robust Equity Momentum Index. And I think we've actually done a pretty good setup here in this interview to talk about the ways that you construct this index. Walk us through it like we're a financial advisor who's been managing money for a while, and we're looking to add this type of strategy or a type of risk diversification strategy, what we need to know about it.
Yeah, so very high level, the first question we want to start with is what is this strategy even trying to achieve, right? And so what we're ultimately trying to achieve with this strategy is a meaningful global equity participation with the ability in a disciplined and systematic manner to try to avoid prolonged and large drawdowns. So that's really what we're trying to achieve here. How we're going to go about doing that is by using these ideas of momentum and trend. We're going to try to invest in equities when we see global equity market trends as positive, and when they're negative, we're going to try to divest out of equities to positions of safety like intermediate and short-term US Treasuries. So that's really high level what we're trying to achieve. The nitty gritty of how we actually go about implementing that, I think, starts with a very, very simple just decision tree. We start by saying, do equities have positive or negative trend? If it's a positive trend, then we want to invest in equities. If it's a negative trend, we want to invest in bonds. So let's say it's a positive trend. Well, then the question is, which equities do we want to invest in? So what we're really focused on from a tactical asset allocation perspective is which region of the world, US, international, or emerging markets.
Your what?
And the what, exactly. And so from there, what we're going to do is say, well, let's look at momentum. Let's look at them. We know equities generally are positively trending. Let's buy the region that has the best relative performance and try to capture some alpha that way. Conversely, let's say equities have a negative trend. Well, then what we're going to do is we're going to look at the treasury market and say, well, which one has better performance right now? Which one has better momentum? Short-term US Treasuries or intermediate-term US Treasuries? And then we're going to invest in that asset. Now, if you do that very simply, you would just end up with a vote to invest in one asset, right? You sort of follow that tree and you'd say, okay, positive, maybe it's positive equity trend and the S&P is outperforming all the other regions and we're going to buy the S&P 500. And you just end up investing in one thing. What you'll note is I didn't say specifically how we were measuring trend. I didn't say specifically how we were measuring momentum. What model are we using? What time frame? And this goes back to that sort of fragility case study. If we don't have a particular view as to whether we should look at 12-month returns or 6-month returns or a 40-week moving average or whatever the model is, our view is that we should diversify that risk. We shouldn't make a single choice, that specification risk. We should try to diversify that risk. So what we do is instead of having a decision tree, we effectively have a decision forest where every single tree is defined a little bit differently. One might be 12-month returns. One might be based on 6-month returns. One might be based on a moving average crossover. One might be based on a price minus moving average model. All these different ways in which you can define these concepts quantitatively. And then what we're going to do is let each tree vote on one asset. So one tree might say, I think it's the S&P 500 is the best thing to invest in based on my model. Another tree might say, nope, it's actually short-term bonds. Another tree might say, actually, it's international equities based on my model. And you might think, well, isn't this weird that you have all these models disagreeing? I would say, well, that's the specification risk we talked about, right? That's if you had just chose a slightly different way of defining these things quantitatively, you come up with a different answer. And so what we do is we say, well, we don't know which one's right. We don't know which one's wrong. Let's make sure we hold these assets in proportion to the number of votes they get. And so instead of having this light switch of just a single tree defined a single way that tells us which asset to invest in at a given time, that all in equities or all into bonds, what our process is ultimately going to do is it's going to blend these. So let's say 2/3 of the trees say invest in equities and 1/3 invest in bonds. Well, then we would hold 2/3 of the portfolios in equities and 1/3 in bonds. And as that sort of ratio changes over time, our allocation is going to look a lot more like a dimmer switch reacting to how these different trend models agree or disagree. And so what happens is very naturally, if all the trend models disagree with each other, you sort of revert back to a portfolio that's pretty well diversified.
It's fascinating. You know, I would have, and I actually did start with the index and the ETF that it follows. The symbol for that is ROMO. And I couldn't understand it. And then I started doing the research on your site. And as I've gone through this process of understanding the different types of momentum and trend following strategies, I understand what you're talking about. The best analogy that I either read in something you wrote or in one of your interviews is you contrast a light switch and a dimmer. And to me, that's really when the light bulb went off as to how this could be implemented in a client's portfolio.
Yeah, absolutely. I think one of the really important things when you talk about implementing something like this in a client portfolio is asking, sort of talk about high level objective. I think it's really important to ask, what's the benchmark? We're so used to in this industry saying, well, the benchmark tells you what you should compare sort of risk and return against, but the benchmark should also inform how you fund an allocation. So what do I mean by that? Well, if the benchmark to this index is a 60-40 global equity portfolio and you want to invest in this index, what that should tell you is you should take, if you want to allocate, say, 10% of your portfolio, you would take 6% from equities and 4% from bonds. You want to take that proportion of equities and bonds to invest in this style of strategy. And so, and the reason you would do it that way is, again, with this strategy being more of a dimmer switch, if you take 6% out of equities, 4% out of a bonds and put it in a tactical strategy, well, then if equity markets are exhibiting positive trends, it can serve to tilt the entire portfolio to increase equity beta. So if times are really good and it's a 2013 and there are clear positive trends, instead of being a 60-40, your client portfolio might now be a 70-30, right? Still within sort of prudent risk limits. On the other hand, if you enter into like a 2008 like environment, instead of being a 60-40, now it de-risks all the way down to a 50-50. And so again, you're not straying too far from that 60-40 base, but this dimmer switch sort of serves as a pivot for you that can help modulate the type of equity risk you're taking in the portfolio.
Excellent. Corey, we are well over time. I could talk to you for another 2 hours. You're a wealth of knowledge. I really appreciate it. Listeners, visit thinknewfound.com. Follow Corey on Twitter, which I believe is C. Hoffstein.
You got it. Yep.
Excellent. Corey, thanks so much for coming on.
Jay, it's been a pleasure. Thank you.